Hello, traders, and welcome back to FXW Markets. My name is Aurora, your senior market analyst here in Dubai. Today is February 8th, 2026, and here are your top crypto macro highlights for today's session. Bitcoin faces a liquidity trap, Ethereum defends the $2,000 floor, and both assets sit at critical macro turning points. Let's dive in. Bitcoin is entering a dangerous liquidity zone, and the catalyst isn't coming from crypto. It's coming from China's accelerating retreat from U.S. government debt. Chinese regulators have urged major banks to scale back exposure to U.S. Treasuries, highlighting concentration risk and volatility. This puts fresh attention on nearly $298 billion in dollar-denominated bonds held by Chinese institutions. At the same time, China's official Treasury holdings have fallen to their lowest level in a decade, around $682 billion. The message is clear: the Eastern bid for U.S. debt is fading. Now, China alone can't break the $28 trillion Treasury market, but the real danger is the term premium, the extra yield investors demand when uncertainty rises. Research from the Kansas City Fed shows that even a moderate reduction in foreign buying can push yields up by 25 to 100 basis points. And in extreme stress scenarios, a $100 billion foreign liquidation could spike the 10-year yield by more than 100 basis points in a single shock. For Bitcoin, this matters because it has been trading like a macro-duration asset since 2020. Higher real yields tighten liquidity, and that typically pressures high-volatility assets. We've already seen this sensitivity. Bitcoin dipped below 60,000 during last week's risk-off move, then rebounded above 70,000 as markets stabilized. So what happens next? Traders are watching four possible scenarios. 1. Contained de-risking, the base case. Slow reduction in buying leads to yields drifting higher, which means mild headwinds for BTC. 2. Term premium repricing, a bearish macro outlook. Yields jump 25 to 100 basis points, resulting in tighter liquidity and crypto under pressure. 3. Disorderly liquidity shock, the tail risk. Fast political selling leads to a violent yield spike and forced deleveraging. BTC drops sharply before rebounding. 4. The stablecoin twist. Stablecoins now hold over $300 billion in U.S. debt. Crypto may partially offset declining foreign demand. Bottom line, China's retreat isn't a crisis signal, it's a fragility signal. BTC remains the cleanest real-time gauge of the liquidity regime. Ethereum is holding the line at the critical $2,000 support zone, and traders are split between a long-term supercycle and a short-term trendline fight. A widely shared chart compares today's consolidation with historical accumulation phases, where ETH moved sideways, absorbed selling pressure, and then broke out. In past cycles, Ethereum built a multi-month base, then surged once buyers reclaimed the top of the range. That's why some analysts argue this is just a reset phase. But the other side is equally important. Ethereum is still stuck in a wide, multi-year range. Repeated rejections have prevented a sustained breakout. On the short-term charts, ETH is now pressing into a descending trend line. Analysts highlight a micro-support band between $2,000 and $2,075. At the time of the chart snapshot, ETH traded near 2,128, keeping the recovery structure intact. In short, Ethereum is at a crossroads. A long-term accumulation structure hints at a supercycle, but a short-term trendline demands proof. If bulls defend the 2,000 zone and reclaim the top of the range, the next major leg could begin. If not, the consolidation continues. That's your FXW Markets crypto macro update for today. For more daily insights and institutional-grade analysis, follow us on Telegram, YouTube, and Facebook. Trade smart, trade confident, trade with FXW Markets.